Welcome to this explainer. Today we're diving into the life, the methods, and honestly, the sheer genius of Benjamin Graham, aka the father of value investing. Before Graham came onto the scene, the stock market was basically viewed by the general public as a giant casino. It was a place driven by speculation, wild rumors, and outright gambling. But Benjamin Graham, he completely changed the game. He took investing and transformed it from a risky roll of the dice into a highly disciplined, measurable science. His principles are so profoundly effective that they literally still guide the greatest investors in the world today.
So let's kick things off with a pretty massive question. Who actually taught Warren Buffett how to invest? If we want to understand the secret behind Buffett's legendary, enduring success, we have to dig down to the bedrock of his strategy. And that bedrock is Benjamin Graham. The stakes of what we're talking about today are huge. We aren't just looking at some neat historical trivia. We are looking at the exact step-by-step blueprint used to build some of the most enduring financial success in modern history.
Section 1. From London to Wall Street, the formative years. Graham's early life was, it was a roller coaster of rapid acceleration, paired with a seriously harsh lesson in financial reality. Born Benjamin Grosbaum in London back in 1894, his family crossed the Atlantic looking for opportunity. But then, disaster hits. 1907. The devastating bank panic completely wipes out his family's savings. Talk about a brutal early lesson in financial fragility and systemic risk. But Graham was incredibly gifted. He lands a scholarship to Columbia University and actually graduates by the time he's just 20 years old. From there, he absolutely rockets up the Wall Street ladder. By age 25, he's pulling in serious money at a top brokerage firm. He was a bona fide prodigy. Which brings us to a dramatic turning point. Section 2. The cost of speculation, the 1929 crash.
Look, even a certified genius like Graham wasn't immune to the absolute euphoria of the Roaring '20s. When the massive 1929 stock market crash hit, the devastation was total. Despite all his early brilliance, Graham suffered catastrophic personal losses. He was practically wiped out. And why? Because he had fallen into the trap of treating highly speculative positions as if they were true investments. It was a devastating reality check. But here is what makes him a legend. Instead of packing it in and walking away, he used this spectacular failure as his greatest teacher. That single failure forced a complete 180-degree shift in how he viewed the world.
Section 3. The margin of safety, Graham's core principle.
So, after the dust settled from 1929, Graham shifted his entire philosophy. Out with aggressive growth, in with capital preservation. And to preserve your capital, you absolutely need a margin of safety. Basically, this is just the gap between the price you pay for an asset and its actual intrinsic value. That gap is your buffer. It's what saves your skin when you make a bad analytical calculation, hit a run of terrible luck, or the market just goes completely crazy. The new rule was ironclad, zero speculation, and you always buy at a steep discount.
Graham actually had this brilliant analogy that I absolutely love. He said, think about building a bridge. You engineer it so it's rated to carry 30,000 pounds, but you only ever let 10,000-pound trucks drive across it. You build in a massive amount of room for error. Investing is the exact same thing. If you calculate that a stock is worth $50, you don't go and pay $50 for it. You buy it for $30. That $20 gap, that's your bridge's extra capacity. That is your ultimate protection against the unknown.
Section 4. The Intelligent Investor, the Bible of Value Investing. Published back in 1949, this foundational text is still basically mandatory reading over 70 years later. Graham hammered home that to be an intelligent investor, you have to ruthlessly separate two concepts in your mind: market price, which is just whatever chaotic number the stock happens to be trading at today, and business value, which is what the company is actually genuinely worth. And here's the kicker. Graham realized these two numbers are almost never the same thing. The market is super emotional, right? It swings wildly day to day. But the underlying business value, that moves much more slowly. To actually exploit that massive difference between price and value, you gotta have your head on straight. The mindset of an intelligent investor demands absolute independent thinking. You have to block out the crowd and ignore market fads. It also requires total emotional detachment. No panic selling when the market crashes, and no FOMO buying when it booms. You have to be the rational one in the room. You also need a long-term perspective. Remember, you aren't just trading a blinking ticker symbol, you're buying a piece of a real, living business. And finally, continuous learning. You adapt to market changes, but you anchor yourself to these core principles.
Section 5. Value Investing Strategies, Beyond Blue Chips.
Now, Graham wasn't just sitting around philosophizing. He was highly tactical. He had systematic ways to hunt down deep value with virtually no risk. First up, net working capital. He loved finding stocks trading at massive, like 30+% discounts to their net current assets. You were basically paying less than what the company would be worth if they just liquidated everything, literally buying a dollar bill for 60 cents. Second, arbitrage. He would systematically take advantage of tiny price mismatches during mergers and acquisitions. And third, tangible assets. He wanted hard physical stuff, factories, inventory, cold hard cash on the balance sheet. He completely ignored flashy, speculative promises of future growth. So how do we actually calculate that intrinsic value?
Section 6. The Graham Valuation Formula, a simple valuation tool.
Graham came up with a brilliantly simple mathematical formula to quickly estimate intrinsic value and lock in that margin of safety. Let's just break it down line by line so it's not super overwhelming. V is the intrinsic value. That's the golden number we're solving for. You find it by taking the EPS, the earnings per share over the last 12 months. Then you multiply that by what's inside the parentheses. 8.5, which was Graham's baseline price-to-earnings ratio for a company with zero expected growth, plus 2 times G, which is the expected long-term annual growth rate of the company. Boom. It's a quick, totally grounded way to cut through the Wall Street noise and see what a business is actually worth on paper.
Section 7. Mentorship and Legacy. The Buffett Connection.
Graham eventually brought his journey full circle, heading back to Columbia Business School, but this time as a professor. And this is where he bridged the gap from quiet academic theory to massive real-world wealth. He mentored a whole generation of sharp minds in that classroom, most famously a young Warren Buffett. Buffett actually credits Graham as the ultimate foundation for his own investment decisions. And when you look at Graham's disciples, guys like Buffett and the legendary Irving Kahn, they prove beyond a shadow of a doubt that his principles weren't just neat ideas on a chalkboard. They were a proven, highly repeatable system for building long-term wealth.
It's been over 70 years since he published The Intelligent Investor, and yet his wisdom remains remarkably timeless. Just think about his wild journey for a second. Marked by losing his family's savings as a kid, suffering a spectacular personal wipeout in 1929, but pairing that pain with an incredible intellectual brilliance and a deep dedication to teaching others. All of that resulted in a philosophy that has fundamentally outlasted him. The father of value investing genuinely lives on today in every single disciplined investor who takes the time to calculate intrinsic value and demands a margin of safety.
So as we wrap up this explainer, I want to leave you with one final, pretty provocative thought that cuts right to the absolute core of everything we've talked about today. Take a hard look at your own portfolio, look at your own financial decisions, and ask yourself Graham's ultimate question. Are you speculating or are you actually investing? Are you just blindly hoping the market keeps going up, or are you buying real businesses at a discount with a rock-solid margin of safety? Because the difference between those two mindsets, that's the difference between just gambling your money away and building true multi-generational wealth. Thanks so much for joining me for this explainer, and I hope this helps you become a truly intelligent investor.